So today we're going to look at Essent, ticker symbol ESNT. What are we trying to accomplish here? We want to find out if this company is worth buying, but we need to study it in order to find out. Otherwise, we're just gambling. So I've boiled down some facts and also included some opinions to help you get started in the process of understanding what I think is a great company. Before the 2020 crisis, Essent was in the mid-50s. Then it fell down below $18 a share, and during filming this, it's somewhere in the $27 range. I'm just telling you this so you can see where it was before the economy turned sour and where it might head again if things turn around. And I say if, but I mean when things turn around. You might be thinking what goes down need not necessarily go back up. That's not a rule of life. Even though it's not a rule and there's nothing we could compare it to, markets have always gone back up after every catastrophe. So the odds are well in our favor that the market will recover this time as well. However, that does not mean each individual company will recover. So we need to pay close attention to any company we do invest in. Essent Group Ltd is a Bermuda-based holding company whose subsidiaries include Essent Guaranty and Essent Reinsurance. Before we go on, we should probably figure out what a holding company actually is. A holding company is an entity created to buy and hold shares of other companies. Those companies owned by the holding company are referred to as subsidiaries. Holding companies usually don't produce anything or provide services, but they hold on to the assets of their subsidiaries in order to protect them from creditors. And those assets might include things like property or equipment. So there's a degree of separation offered through structuring a company this way. And it reduces risk should a company become insolvent, which means it can't pay them bills. It can also be beneficial to have a Bermuda-based holding company for tax purposes, although the Trump administration in 2016 limited those benefits. But aside from that, there's some financial wizardry offered by the holding company structure. Holding companies have a greater ability to buy stock in other financial institutions, which allow them to diversify. They can issue debt. They can move assets around more easily between the subsidiary and the holding company, thereby reducing risk. Or if one subsidiary loses money in any given tax year, they can deduct those losses from the income of another subsidiary, thereby reducing taxes. It's also easier to get a low-interest loan as a holding company. So there's a bunch of other advantages to the holding company structure as well. Now that said, holding companies are somewhat more expensive to maintain, and they're also regulated by the Board of Governors of the Federal Reserve System. So there's an added layer of regulation on an entity like this. Coincidentally, the Chief Risk Officer of Essent Group held a research position with the Board of Governors of the Federal Reserve System.
2 very boring minutes later.
So what does Essent do? Let's just get into it now. What does Essent do? So Essent Holding owns 2 subsidiaries. Essent Guaranty provides mortgage insurance for single-family homes throughout the US. They're founded in 2008. What a year to get into that game. So they essentially mitigate risk for the lender and the investor. See what I did there?
Several bad puns later.
They also have a second subsidiary, which is Essent Reinsurance. So reinsurance is insurance for insurers. Yeah, that's some Inception level dream within a dream kind of thing, okay? Reinsurance is when you have other parties take on a portion of your risk portfolio and you thereby reduce the ability for one claim to affect you. As an insurer, you may not want to have one big ball of risk. So if you can split it up and offer it to someone else, that allows other people to share in the profits, and you can make the deal, but you don't have to take on all that risk with your limited resources. So in Essent's 2020 annual report, the CEO Mark Casale talked about their new risk-based pricing engine called Essent Edge. Essent Edge allows them to assess and properly price the risk on one end when the loan is originated, and then using reinsurance on the other end, they can mitigate risk even further. So overall, they're able to originate the loan using Essent Edge, manage the loan, and then distribute it using Essent Reinsurance. So one quick aside, Mark also wrote that he believes capital begets opportunities. And that's a great quote. You have to have money sitting on the sidelines or you'll miss all the great opportunities that come your way. To me, it doesn't matter what great deals come along. If I can't invest in them, it just ends up making me upset. Essent operates in the US housing market only, so we should probably have a little look at how the US housing market works. There are two types of housing markets in the United States. There's the primary and the secondary. So the primary market is like when you go to the bank and take out a loan for a house, or if you go and refinance a mortgage. That's also a part of the primary market. The secondary market is when institutions buy and sell mortgage-backed securities, which are sort of a basket of mortgages that pay the holder periodically. Or it could also just be a single loan, which are referred to as whole loans. So if you're old enough to remember the Great Recession of 2008, you'll remember that mortgage-backed securities were a pretty big deal. Institutions at the time were buying these baskets of risky subprime mortgages. And eventually, holding all this junk mortgage debt just took its toll. That's what they say brought down the economy. So on the one hand, institutions need to diversify their portfolio using these mortgage-backed securities. But on the other hand, they have to be very careful about what's actually contained in that basket of mortgages, lest they should play some sort of game of hot potato with a financial bomb. So GSEs, or government-sponsored enterprises like Fannie Mae and Freddie Mac, purchase mortgage-backed securities from these financial institutions to provide liquidity to the market. But they can't purchase these mortgage-backed securities unless the loan has a 20% down payment. Unless the mortgage has private mortgage insurance. And that's where Essent comes in. So to give you some understanding of how important GSEs are in this game, you could consider that the US mortgage market has over $11 trillion of debt outstanding. And GSEs hold or guarantee 4.9 trillion of that. That's a lot of the market, man. So let's meet the team. Let's meet the cast of Essent. Essent CEO Mark Casale is the founder and has been there since '08. He has 25 years management experience in financial services and was in senior management positions with Essent's competitor, Radian Guaranty, from '01 to '07. The Chief Risk Officer, Vijay Basan, has been with the company since '09 and has held management positions at Freddie Mac. He's also held research positions with Fannie Mae and the Board of Governors of the Federal Reserve. Those are the guys who implement monetary policy in the US. 5 out of 6 members of their upper management team have worked at Essent for over 10 years, which is pretty good considering they've only been around since '08. So one thing I really like is their performance-based pay system for management. I really enjoy this. Mark Casale, for instance, makes a base salary that's 12% of his income. 30% of his income is an annual cash incentive. That would be like a bonus. And 58% is a long-term equity incentive award. So that's like a bonus with an incentive for long-term rather than short-term gains. So 88% of his pay is performance-based. And with the other executives, like the Chief Risk Officer, it's a little lower. It's 78% is performance-based pay. I really like this. If I owned a company, which I do now because I bought shares of Essent, I would pay my employees with a performance-based system. Honestly, I don't understand why the regular method of paying people, at least down at our level, is an hourly system. Hourly pay just doesn't make any sense. Unless you're the Maytag repairman or something, there's just no point in paying someone to show up. You want to pay people to work. And the incentive behind an hourly pay system is just to be somewhere for an amount of time. And you see, hourly employees generally don't care about efficiency. It's got nothing to do with them. And if they do care about efficiency or performance, it's running contrary to their system of pay. That's just because of the kind of person they are. It's got nothing to do with incentive offered by the company. So hourly makes a lot of sense if you're a manager and you want to encourage the company to hire a bunch of managers, because you're going to have to constantly go around and inspire your workers to work harder because the financial system you have in place isn't doing that. It's just paying them to be there. Doesn't matter what they get done, doesn't matter when they get it done. So you need all these managers to help with that. So this is the 3rd year that Essent has offered these bonuses, and not just to management, but also to all of their employees. And I love it. Now you're aligning the mindset of the worker with that of the business owner. And as an investor, that's something I really appreciate. So that's great, but tell me about their margins. Essent's operating profit margins for March 2020 are 64%. That means that every dollar of business they do, they keep 64 cents. That's huge, man. That's bigger than Visa. That's bigger than most companies I can think of. That's an amazing profit margin. Their revenue and net margins have been growing consistently over the last 5 years. There are really no metrics I've come across that raise any red flags or make Essent look bad. Everything looks pretty good. So there's a lot of people out there who like dividend investing. So how about the dividends? Essent began paying a dividend in 2019 at 15 cents a share. This quarter they raised it to 16 cents a share. So in a world where all these companies are cutting dividends, they are raising their dividend. Now, to be fair, they might end up cutting their dividend, but I really doubt it. Their earnings per share is $5.66. So a 16-cent dividend is just, their earnings would have to be so bad for them to even consider cutting that dividend. I think they're relatively safe. And also having a small dividend like that allows them to retain a lot of capital to use on growth opportunities. And in this market, if you don't have money, things can get tough. But if you do have money, there's opportunities everywhere. So what about value? Is Essent a value as of March 2020? March 2020? So Essent had $4.1 billion in assets. When you take away all the liabilities, they have about $3.1 billion in equity. And their market cap is about $2.64 billion. So by that metric, they are undervalued. Also, they have $3.1 billion in reinsurance protection. So that's almost all their equity. The earnings per share for March 2020 have beaten the last 4 preceding quarters. Their insurance in force for this quarter grew from $1.64 billion to $1.65 billion. And the term in force means that the policyholder has either paid or has began making payments. So Essent also has a $500 million credit facility. And for the last 4 quarters, up until the end of 2019, they've had about $225 million withdrawn from that. They now have $425 million withdrawn from their $500 million credit facility. So they've almost doubled their withdrawal. Hopefully they're using that on opportunities. And the interest they're paying on that is under 3%. Man, I wish I had a $500 million credit facility. I'd be buying some Essent. Now, it's unclear to me what they're using that withdrawal from the credit facility on. But in their 2019 annual report, it sounded like they'd be using it on opportunities, so hopefully they've found some. Essent said in their annual report that they have an adjusted book value of $30.89. In general, Essent offers insurance to people with fairly high credit scores. 746 was the average credit score for this quarter's new insurance written. Now, how that'll play out in an environment where a record number of people are out of work is beyond me, but I would assume those stimulus checks are paying people's mortgages. In my very limited knowledge about the future, I really can't see most people who have a mortgage missing any payments because of both the stimulus checks and credit. However, if people have a bunch of houses, the renters in those homes might not pay their rent. And I've seen a lot of rent strike signs up around my town. So you never know what's going to happen. But I hope that most renters have enough foresight to not do something so damaging. So one metric we can use to gauge how problematic the 2020 crisis will be with Essent is the default ratio, which Essent's current default ratio is 0.85%, so under 1%. So we could compare this current ratio to their future ratio in order to see what kind of damage it's caused. But of course, anything like that's going to be hindsight and can't help us with making predictions about the future. This company's pretty good, but that doesn't mean it's not without its risks. Any company is going to come with risks. So let's have a look at them. So what are the risks with a company like Essent Holdings in the mortgage insurance and reinsurance game? First, there's the economy. At this point, it's very hard to say how deteriorating economic conditions will affect a company like Essent. It's also very difficult to tell how negative interest rates might impact their business. Both of those will have some degree of impact on the business, but how much I can't say. Another risk of Essent is large customers. Essent has several large customers, and if they were to lose one, that could impact their business in a very big way. Of their new insurance written, 42% of it is just 10 customers. So one of those being gone could be a big deal. Good relationships with customers are a strength, but they can also be a big vulnerability if they lose one of those customers. Now, another threat is going to be competition. This is a very highly competitive business, and with margins like 64%, people are going to want to be in there. They're going to want to be getting a piece of that pie. However, private insurance has been able to wrestle market share away from government-sponsored enterprises since '08. So it's been a bit of a growth industry for private insurers. But don't let that fool you. The competition is fierce from both the private sector and the government-sponsored enterprises. However, in 2019, the Trump administration pushed the US Treasury Department to reform the housing finance system. Among those reforms is the Directive to facilitate competition in the housing finance market. How exactly that reform or any of them could impact Essent's business remains to be seen. Then there's the nature of the business itself being a risk. According to Essent's annual report, claims tend to rise during the 3rd to 6th year of a loan's life. So they expect loan claims to rise as their portfolio matures. They go on to say that default rates will be affected by housing prices, interest rates, and employment numbers. And all three of those things are huge variables considering the 2020 crisis. So in summation, Essent looks like it could have some growth opportunities ahead of it, especially if the government is looking to get out of that market to some degree. And on the one hand, everything about Essent that is measurable looks great, but on the other hand, the 2020 crisis just throws in a whole bunch of variables. Obviously, the market's been pretty volatile, and a lot of people think it could head lower. So if you think that it might head lower, you might want to put Essent just on a watch list and, hopefully get that price you're looking for. And depending on what price you buy at, most of the risk associated with this stock is already priced in. Now, in a situation like this, with wild, drastic price swings from $55 down to $18, back up to $27, it's hard to say at what point you want to get in at exactly. I can't really give you a number, but I think anything under 30 is a pretty good deal. So if you like this company, but you're worried about the effect that the 2020 crisis might have on them, take a play out of Essent Reinsurance's playbook and diversify out some of the risk. Anyway, I hope you enjoyed this video, and thanks for stopping by. If you like what you saw, give me the thumbs up and subscribe. And don't forget what I told you.